Welcome to the latest Eversheds Sutherland Legal Insights podcast.
Hello, and welcome to Hot Takes, the companion podcast of our series of interviews with leaders and luminaries from the financial services industry, exploring trends and opportunities in global financial markets in 2025. I am joined today by my Eversheds Sutherland colleagues, Tim Fosh, a financial regulatory partner in London, and Michael Koffler, a securities regulatory partner in New York. Certainly two of our best and brightest in the FS Reg space. And of course, I'm your host, Sierra Nicholson, the global strategy and development lead for the financial services sector. Tim, Michael, welcome.
Thank you, Sarah.
Great. So we've just heard our colleague Matthew Allen in conversation with Brendan Riley at Barclays on regulatory change and fragmentation. And that's a topic which we're going to explore further today. So thank you both for being here, and I'm really excited to hear your hot takes. There are a few themes from their discussion that I want to unpack with the two of you. And the first is this pervasive nature of technology change and how it overlays macro issues in the regulatory arena. Tim, I'm going to come to you first. In your observation, how is technology change shaping regulation in the financial services industry?
I mean, I think there's a number of ways it's doing that. Obviously, technology is opening up all sorts of new products, services, activities that financial institutions can give to their clients, and those are normally sort of at the cutting edge, and where the competitive advantage is greatest is at that cutting edge. But from a regulatory perspective, that sort of makes it very difficult. I mean, regulators are looking at new things, new concepts even that won't have necessarily crossed their desk before and won't necessarily be within their conception, within their imagination a lot of the time. And that's a tricky challenge. And it means that sort of poses them a number of different options as to what they're going to do with regulation. Do they be proactive and try and get ahead of things? Do they try and be reactive and not get over their skis? Are they trying to be innovative and supportive? Are they trying to not stifle innovation necessarily, but getting people to hold their horses? So that's sort of one of the ways and one of the things they've got to respond to. I mean, that's on the product side, but I mean, there's also delivery. Obviously, there's all sorts of new delivery methods that technology facilitates. I mean, whether that's the use of AI, obviously things like chatbots have been around for a while, but I mean, more and more automated decision making. How do regulators deal with that? These are new problems that from a regulatory perspective are being posed, but from a financial institution perspective are opportunities. These are sort of great new exciting things and ways to provide services to customers, but then how do they balance that with the regulatory response to it? And I mean, in a slightly more positive way from a regulator's perspective, that these things and technology more generally offer opportunities for more effective supervision. I mean, data is the new cash in being king, and regulators are asking for more and more of it, and they're doing that because they can see more and more things with it. I mean, it's not coincidental that the FCA now employs a team of data scientists, where sort of 10 years ago that would have been sort of broadly unthinkable. So technology sort of works on both sides of the fence. I mean, obviously it's more developed on the financial institution side, but there are sort of ways, hopefully, that financial institutions and regulators can begin to talk to each other in a more sort of responsive and more sort of intuitive way that actually leads to better outcomes for everyone and a greater engagement sort of between them. So, in short, it's driving sort of everything that's happening.
Yeah, Tim, you raise a really good point about how tech changes at the same time, creating an environment that regulators need to, figure out how to approach, right? But also enabling them to take a different approach. Michael, your practice is focused on broker-dealers and investment advisors in particular. What impact is technology change having on those institutions from a regulatory perspective?
Sure. Thanks, Sierra. The impacts are rather profound and numerous. The very products that are being bought, recommended to clients, are changing. Many of them didn't even exist several years ago. Just take ETFs tied to Bitcoin and other types of crypto assets. Tim mentioned AI. It's changing how research is conducted, how data is analyzed, has an impact on the recommendations that are being made by broker-dealers and investment advisors, how these firms communicate with clients and investors and regulators, the use of data, as Tim mentioned. Tim also mentioned, other types of technologies that are having an impact. Take the issuance of securities directly via the blockchain that is opening up a whole new world. Potentially could lead to disintermediation of certain actors in the securities industry if issuers can directly issue their securities via their own blockchain to the market. That also is going to have an impact on how securities could be traded in the future, where they're traded on a blockchain, which of course is going to have impacts on books and records on how they're maintained by broker dealers and investment advisors, and how securities are settled if they're settled on the blockchain. So the whole plumbing underlying the market infrastructure potentially could change rather dramatically in the next 5 to 10 years. And I love Tim's example with respect to data. So much of the technology poses tremendous challenges, but at the same time poses potential solutions for dealing with those challenges. And AI, you see AI leading to all sorts of challenges, but also new ways of looking at how firms supervise and search for problems and compliance risks and deal with the risks, whether it's marketing risks or it's how assets are deployed and the recommendations that are made, and dealing with all sorts of trading risks and counterparty risks and diversification or being too concentrated. So AI opens up so many things, and it's on both sides of the ledger, as Tim said. So it's really every aspect of firms, how they conduct business could dramatically change over the next decade.
Right, Michael. And the comment that you made about the whole underlying plumbing could be changing is actually a really good segue into the next thing I wanted to ask you guys about, which is, Brendan talks about smart regulation and the need for a refresh of the post-2008 rule book. What are your thoughts on that, Michael? I'll stick with you first.
Sure. I mean, I agree with Brendan. We've had, over 15 years of regulators layering on, different types of protection for the market, and it's been layer after layer after layer. And I think it does make sense to step back and take a look at what's working and what's not working, and to adjust course as appropriate. Things were implemented in a certain time period. It's natural that our laws and regulations are historical. They all reflect what was going on at the time. But what's done less often is for regulators to take a step back and say, okay, what are the impacts and what's working, and look at things holistically, because a lot of times you have a regulation or statute that was implemented for a particular purpose, and there are unintended consequences that may not become apparent for years. And so you want to keep the best of what's working, but maybe scale back some things or change certain things that aren't working as well. So I agree with that. The need to do that, and it's an appropriate time to do that. And just to give an example of what I think of when I hear the word smart regulation, Brendan talked a lot about capital and liquidity and making sure there's adequate capital and via the different standards that are out there. I'll mention that in the United States, there's been a big push by the asset management industry to make sure that they're not treated as banks. And that's an important point, because the Financial Stability Oversight Council, or FSOC, has from time to time made statements suggesting that that would be their preferred route. And I think it's important to look at the business models and say, wait a second, asset managers are not banks. Even though there is a piece of what they do that brings them within the shadow banking discussion, they're still, at the end of the day, they're not banks, and their purpose is not to act as a bank, and they should not be treated as banks. And so, to me, I think tailoring regulation to the business model, which is something that Brendan mentioned, is an essential principle that should always be maintained, in my view.
I agree with you, Michael, and it was really interesting, as you said, to hear Brendan talk about that too. Tim, what are your thoughts?
I don't think I could agree more. I mean, obviously, the risk inherent in regulation is that you regulate and legislate to prevent the previous crisis because that's your experience. And obviously 2008 is a long time ago. The risks that were around in 2008 and that crystallized in the financial crisis aren't the same risks as we pose now. I mean, it's a case really of properly identifying what those are, and those generate from firms' business models, what they're doing, how they're interacting with the economy, how they're interacting with sort of people on the street and the financial system more generally, and how that financial system works in a world where the piping is potentially changing, as Michael referenced. What does that mean for the risk? Where are these systemic risks coming from now? Because they're not the same as they were in 2008. How can regulators and regulation appropriately sort of respond to that? Because I think they need to acknowledge the fact that things are different, and it'll be sort of the successful ones that identify those early and respond to them appropriately, at the same time as fostering the growth that everyone's after, recognizing the fact that growth in and of itself might sort of increase the risk, but jurisdictions shouldn't necessarily be seeking to be completely risk free.
Yeah, that's great, Tim. And it's perfect that you brought up growth there, because I think that's a good caveat to the next sort of theme, which is kind of around innovation and innovative change. So, Michael, one of the things that Brendan mentioned was the democratization of private assets. There's a significant development for your client base because it opens up a new universe of assets to retail investors. How might this change impact investment flows in the period ahead?
Sure. Well, clearly there's going to, this, as this carries out and we see this play out over the next, several years, there's going to be more capital allocated by retail investors to private assets. One of the big questions that stems from that is, will we end up with the right amount of assets allocated to privates by retail investors? It's important to bear in mind that the characteristics of private securities are very different than those of public securities when one thinks of risk, time horizon, liquidity, etc. And I know certain regulators in certain parts of the consumer protection industry is very concerned that retail money will end up being over allocated to privates and end up benefiting private issuers more than retail investors. And so that's clearly a concern. And there will need to be protections built in to prevent that from happening, along with policies and procedures by firms themselves that they'll need to implement to ensure that there's always a good fit between a given investor's financial circumstances and what they're investing in and how much they're allocating to private securities. Of course, for most investors, most retail investors, and obviously there are exceptions to the rule, but for most retail investors, privates should be, a part of their portfolio, but certainly not the majority of their portfolio. So, again, going back to something Tim mentioned earlier, it comes back to balance. How do you balance the promise of what privates can offer over public securities, at the same time protecting the retail market? And it's important to get that balance correct.
Yeah, that's a great point that you make, Michael. And just thinking of my own financial advisor, I'd be shocked if he suggested an unbalanced portfolio that was heavily into private assets. Tim, one last question for you, and then we'll wrap it up, guys. Brendan talks about the tremendous pace of change in the digital asset products and in digital asset products and market development. I know this is an area that you've been very focused on. How are regulators and the industry grappling with this next-gen landscape?
Well, I think the regulators have been dealing with it with sort of various degrees of success. It's a fascinating use case because it's something that started out as truly global and sort of borderless in many respects, and designed to be borderless and permissionless. And regulators are coming at it a bit post facto, trying to impose regulation on it on a jurisdiction by jurisdiction basis. And it sort of led to a variety of different approaches. I sort of referred to some of these earlier. Some have gone out and sort of made rules early and fast. Some have been more reactive, trying to see how things play out, where the risks are. Some have tried to sort of innovate, be helpful, be fostering, create sandboxes. Some have been sort of more restrictive. And so it's led to a bit of a patchwork, which is actually not the easiest things for sort of market players actually to balance. And it therefore has made some places more competitive than others, but has sort of stifled the global all at once approach that sort of many of the firms would want, and sort of philosophically underpins some of the stuff that historically they've been offering. I mean, the industry itself is always looking for the next thing and for competitive advantage that brings them, but at least the traditional financial industry is looking for a way to do that keeps them out of trouble and that is compliant from a regulatory perspective, and that they look to push the edges, but they do it safely. So sort of engaging with the regulators to ensure that they're doing so within the rules, often within rules that weren't designed to regulate this kind of thing, is important to that. That's on the traditional side, but on the sort of more DeFi side, people are far more sort of used to the whole move fast and break things philosophy and the whole ask for forgiveness rather than permission, which in the long term doesn't necessarily sort of work for them. There are a number of use cases where people have gone ahead to create market share, but then have slightly regretted it later that they build up sort of regulatory issues for themselves. So it's a very mixed bag, and there have been success stories both from a sort of market and regulatory perspective. But I mean, it's still developing, and it's more and more sort of what was created and conceptualized as a completely unregulated thing being retrospectively fitted into a regulatory environment, and that in some instances is as uncomfortable as you might think it has been. But as I say, there have been a number of success stories, so it continues to develop.
Yes, I think that's one to watch for sure. Well, Michael, Tim, thank you so much for your time today. And of course, our thanks to Matthew and Brendan from Barclays for giving us great food for thought and discussion. Tune in all year long for more hot takes.
Thank you for listening to the Eversheds Sutherland Legal Insights podcast.